I have lived long enough to know that opportunities must be seized or they will be lost.
Hello and welcome back to Wall Street Radio. I'm your host, Tanner Yarton, here with Dan Young. It's the 26th of February, 2025. And in this episode, we're going to be talking about Nvidia earnings today, green card versus gold card, Trump's new announcement to stimulate the economy and bring employees from the rest of the world into the United States. We're going to talk about the 3-day rule and kind of some price action techniques, MSTR positioning and thoughts, and where we think that's going to end up. Rotation into healthcare and kind of the rotation into value that we've been discussing on this podcast for a number of weeks at this point in time. The international trade, SMCI volatility, and how tops are a process in the market and what kind of signs we're seeing that might indicate that that's starting to play out here today. Enjoy.
Let's go. Let's get right into it. So the market has been bouncing around a good bit, which we talked about, obviously, the past couple of days. After the big rejection on Friday, we've kind of S&P formed a top, big sell-off. It's been kind of a little bit of a hemorrhage sell happening, big liquidation events. Yesterday, it did close and come back a little nicely, but there's a lot of uncertainty in the market. So, jumping right into the first topic, Nvidia earnings today. What are you expecting?
Well, like we talked about last episode, I think these earnings are super important for not only Nvidia, but for the market as a whole. Nvidia has been consolidating for some time now. And I think if we're going to start to see the cracks in growth, they're going to appear in this earnings specifically. It's the first quarter of Trump's presidency. And I think if companies are uncertain about the future with Trump, they're going to start to slow down on that spend. And that would have appeared from right after the election all the way up through inauguration. And those are going to be impacted, or those are going to be shown or materialized through these Nvidia earnings. So I'm absolutely going to be listening to that earnings call. I'm going to be paying attention to the report. And again, I'm not positioned either way. So more so for me, just kind of watching and seeing what happens and seeing how it reacts. If things are great and strong, then, sure, we might get a comeback on some of these growth names that have been selling off, I think, in anticipation of Nvidia earnings. But if they get nuked, it's kind of a lot of the stuff that we've been talking about is coming to fruition, and that's fine by me as well. What about you?
Yeah. Well, a question back to you, and then I'll give you my opinion. Do you think a positive earnings by Nvidia today and like maybe a pretty drastic win overall nukes the market into, not nukes, but sends us over 600 once again and gives us validation to enter that next price curve for 610, 620, and so on?
Yeah, when you talk about hyperscalers and some of these companies that have had hero digital chip SKUs over the last 50 or so years, after a couple of years, they really need to blow out to make a big impact. And you and I, not on this podcast, but you and I have talked about this a lot about companies that are hyper scaling and growing really quickly. Eventually, the market just anticipates a beat. So do I think Nvidia is going to get beats on estimates? Probably. But unless they're blowout numbers, I don't think it's going to have as positive of an impact as people expect. Would you agree with that?
Yeah, I would. Blow out to show out, right?
Yeah, right.
Yeah.
Price is just like expectations have just caught up. Like who's here still who has not bought Nvidia, who's just waiting on the sidelines to do it?
Right. Yeah. You look at HIM's earnings the other day. What a drastic sell-off they had. And I think they beat on all accounts. And that goes back to conversation with a friend the other day about earnings estimates and Wall Street expectations and all these different factors that don't end up meaning a lot in terms of where the stock price will move after an earnings report. It's all about the current valuation and what the expectation is, but more importantly, what the guidance is for the future. And so, whether a company, I've seen it, you've seen it, a lot of people listening to this, I've seen it time and time again. Someone beats all the expectations, their revenue comes out on top, and the stock drops 5%. Right. So you just have to know that these correlating factors of, how they perform versus the market expectation is not the end all be all of the truth and direction of where the price will be. As we all know, price will be determined by volume and where the market wants to take it post earnings. And that's the most important thing to look at. So, if they beat earnings and the market loves it and it jumps 10% immediately, then it's probably going to get good continuation. If it beats on all accounts and it drops 10%, there's either extreme oversaturation and overvaluation in that stock, or it's something that we need to look at in terms of guidance. So as always follow price. For me, I do think this is make or break for the market. It's all come down to this. It's felt like that for the past couple of weeks, just because we need a little bit of spark. Like we need that spark plug, which is Nvidia, to ignite the market engine to continue to keep on this path of destruction that it's doing, which is year over year. It's had really impressive gains coming out of COVID and really, really strong performance, especially in like growth sectors and with chips, AI, quantum, like all these things revolve heavily around Nvidia. And like if we're going to produce this type of economy that circulates in semis, they have to lead. There's no but about it. And you have AMD, which has been suffering as of late. So like, who is the new leader? And if they can't lead, the question becomes, is that backstop into healthcare, industrials, those type of safer havens for money and more defensive? Like, are they really going to lead the market? Certainly not for the S&P based off the weighted distributions, but you'll have something like the Dow Jones that will do extremely well. But I'm very interested to see what happens today. I think, one way to manage it that I'm doing is I'm just making sure that I don't have too much risk on. And that's something I always say to anyone when they ask me about, how do you trade around like times like this where the market's selling off, or it's easy to be fearful, right? When like you have a day like last Friday or even this week when there's a lot of liquidation events and the market can be down 1%, 2% consecutive days. You just have to understand what your risk is and what your time frame is. If you're 25-year-old, if you're a 30-year-old, you're long S&P, you're long certain names for 5 to 10 year horizons. This is not a time to be too concerned. This is actually, in my opinion, a time to look for entries. I took some entry positions in some long names yesterday just based off a 3-day rule that I generally follow, and that goes for upside and downside. So if you're taking a trade or you're looking for an entry or an exit, what you're generally looking for is an exaggerated move 3 days in a row upside is a good time to probably take off a position, right? It de-risks you from further, loss of value on the way back down, because there will be that inevitable cooling of the stock price as it sets up a new leg. Now, obviously, like that's on a swing trade or a short-term trade. If you're going long something, the 3-day rule doesn't really apply because you want to play out no matter what. But if you're swinging or you're short-term trading something, it's all about risk reward. That's the name of the game. So 3 days up, I'm generally taking profits or I'm lessening my position to secure profits and then waiting for the next leg, or just understanding like at that point, my reward is generally going to decrease. And the same thing for taking positions on a 3-day exaggerated sell off, like well below historical price value. I'm going to take a starter position. I'm not going to go full bearing into a position, but I'm probably going to, slowly average into something and see if I can catch a bottom. And catching nice can be tricky. That's just when you have to know, like, what is the news? Was it a terrible earnings? Did someone step down in the company? Or, hopefully, like what I look for is if it's a market correlated sell off and there's nothing really changed about the company and the foundation of the company, it's just now had this exaggerated selling due to other market factors like the S&P or the broad market. That for me is a good time to cash in, because again, risk reward expectation and value becomes heightened at that point. And so again, for me right now, I'm just generally looking at where Nvidia is going to go, but more importantly, where is my portfolio? How much cash do I have? What's in bonds? What's in equities? And making sure that, I also stay active in the market if Nvidia comes in and tanks today and I see it impact some of my stocks to value to where it's now like lower than fair value and like well lower than industry peers, I'm going to take positions. And that's just like, you have to do that, especially if you're holding something for like a 3 to 5 year basis.
Yeah. A lot of these growth momentum names that we've seen taking huge haircuts recently, those stocks, I think, are doing so waiting for Nvidia earnings. So if we do get a big sell off in Nvidia and that takes the whole market with it, I think a lot of those that have already sold off 30, 40, 50%, especially in the groups that I pay attention to, electricity, the whole electricity value chain, nuclear, space. I think those going down even further into that, 40, 50%, then it's going to be a time for me to start looking at the valuations of those and kind of seeing, okay, realistically, is this a decent buy spot just from a fundamental perspective? Now, the more speculative stuff like space, especially, is really tough to value. So for me, it's going to be more about a technical buy than anything. But you're absolutely right. If we get a big sell off in NVIDIA, after most of the growth names that are impacted by NVIDIA have already sold off 20 to 30% going into these earnings, then we'll approach levels I think are fundamentally sound to start adding in. So yeah, I'm right there with you. And
Yeah,
sorry,
yeah,
just one more thing. As far as positioning goes, most of my stuff recently has gotten stopped out just because going into these earnings, we're seeing growth take an absolute slam. And as everybody knows, that's where the majority of my portfolio resides most of the time, at least my swing trading portfolio. So I am pretty heavy on cash right now going into these earnings. And I'll be looking for opportunities in the event that either these earnings are a non-event, which would go against what both of us have been thinking for a while, or they get a large sell-off, and some of the names that I've been looking at just enter prices that make sense fundamentally.
yeah, and we talked about overvaluation and saturation, a little bit of technical and fundamental. I wanted to bring up two different trades and two different ideas that have been rolling out the past couple weeks, especially the past couple days. One on your end was Tesla short. One on my end was the MicroStrategy or strategy short, and that was discussed on the podcast in previous episodes. So why don't you talk me through Tesla first, and then I'll talk some of the audience through MicroStrategy.
Yeah, sure. So we talked about this not too long ago, but back in when did Elon buy Twitter? Was it 2021?
Ooh, that's a good question.
I think it was 2021. In any case, when Elon Musk bought Twitter, there was a ton of speculation that Tesla was going to take a hit from it because people just couldn't possibly fathom that he would have enough time to focus on all of his little babies all at once. He's got a lot of companies and a ton of exposure as far as his time is concerned. And we're seeing a lot of that right now as well. We're seeing people say, hey, how can he spend so much time on the government and with Trump and doing all these pressers and, you know, really using his time for the American population instead of on his own companies. And then what you see is a slide in Tesla stock because of that. We saw that during the Twitter acquisition, and now we're seeing that right now with Doge. So the Tesla short was both kind of fundamental and technical. It was starting to slide, I think, based on this news that he was just so involved in the government, but also the fact that there isn't much value moving forward for Tesla. And this has kind of always been my opinion and why I don't own it in my long-term portfolio at all. It's a great swing trading stock. It's a stock that can go on huge runs on small pieces of news because it has such a large fan base behind it. And there's a lot of speculators on it. But as far as actual value goes, there isn't much coming down the pipeline for Tesla that really jumps out at me as like a large value add within the next 1 to 3 years, which is usually what price is going to try and price in. So for me personally, when you get a large run like we saw over the last 6 months, especially post election, to me, I want to catch that upside as much as I can, but I also need to recognize that this isn't something that I think can run for 2, 3 years at a time with no real value adds. Obviously, we anticipate Trump is going to help out Elon Musk as best he can, and I think that's fine. But at the same time, have to be weary of the fact that robo-taxis and some of this full self-driving and the value adds that everybody brings up for Tesla, I don't see them actually playing out in the near term, and price is going to reflect that. So you get a large run off of the election, and now it's like, okay, people are like, okay, where's the value here? And there wasn't any. And sure enough, that short played out. I think we mentioned that one last week.
Yeah, so that brings up a couple of points that I want to stick on. One, the competitive advantage that Tesla had, whether it's electronic vehicles versus self-driving, the market has caught up. Or it's, his first step advantage into that has decreased substantially, which is a very big factor. Think about like robo taxis, the integration I'm a believer in Uber long. I don't hold the position, but I actually do believe the company's set up for success in the future, especially taking advantage of things like robo taxis. If they can, cut down costs of actual drivers, that seems like a really nice play for them into the future. But I don't know if Elon and Tesla is going to be the supplier of that. There are a lot of different car companies right now that have self-driving protocols that are there initiating with their customers. So I don't know if they have that first of advantage, which was a huge part, in my opinion, of what they're doing. The second big thing for me is the distraction that Elon has had, as you mentioned, with Doge. And we've been harping on that. I've been harping on that like for at least the past month and a half, really since Trump took his seat as president, because it's just been nonstop. It's all about Elon on X. It's all about what he's doing. People are making jokes about, President Elon. Internationally speaking, it seems like a lot of people hate him. People are turning, we've seen this meme and this trend of people turning in their Teslas saying like, fuck you, Elon. Sorry for the language, but it's just, I mean, that's like what they're saying. They're writing it on cars. Cybertrucks are getting destroyed downtown in New York. Like, that is the risk you take when you're a business owner and you represent a pure brand and product, and then you go and you become very volatile with what you're saying, right? This is the outcome. And that's why I was so surprised, to be honest with you. Like, I know he obviously has a high ego, he's highly intelligent, and he was going to do these things, but the legality wise, like, I actually didn't know how that would play out, because he is such a large representation of a shareholder complex in Tesla, and now with SpaceX and all these other companies and Starlink. So like, it's interesting if you're investing in one of these companies, whether you're a seed investor, a shareholder, I wouldn't be happy with what's going on, because it really hurts and limits the brand, no matter how good the product is. I mean, a product could be absolutely fantastic, but it's not going to be once in a lifetime. And I know SpaceX and Starlink, like, those are pretty generational things, but Tesla used to have that same excitement as a SpaceX and a Starlink. And 5 years later, it seems like it's kind of swirling in the toilet a little bit. So it's just been interesting. I think right now, a lot of people who are buying Tesla are well aware with what it can offer. And there's, if I'm an 18-year-old today getting access to a brokerage account, I'm not buying Tesla, which is another thing we haven't talked about. The lower generations, or the younger generations like Gen Z and the ones to soon come, are they really going to invest in Elon? They probably think he's a pompous ass, because they don't really have that much history of him with PayPal and like the early days of Tesla. They were just, young kids. So that's another thing you have to think about, is like a new generation of investors. Where are they going to put their money and their time? And I don't think it's with him. And that brings up a perfect segue to one that I wanted to talk about, which was a short idea, probably from a month, if not, 2 months ago, that's been building, was the MicroStrategy/strategy short. I've talked about it before. I don't like Michael Saylor. The moment that I wanted to short that company was when I think he was on CNBC, and he was like overly confident. He was like, "We're buying Bitcoin until it's $1.2 million," or whatever he said. And he just got so much fame and press the past 2-3 months from buying Bitcoin and being this guru about it. And like, he got so much fame. And then you're like, wait, why am I even buying this? Why don't I just buy straight from Bitcoin? Because at that point, I mean, there was a point to buy MicroStrategy that you brought up, which was an awesome arbitrage trade like a year ago or 2 years, whenever it was, where the actual value of Bitcoin was so depreciated on MicroStrategy's book that it made sense. You're automatically, book value wise, in the green. Now it's like, well, why would I even buy them? And it just became too over leveraged, right? That's the thing for me that was like the most attractive part about the short, which is he's so over leveraged in Bitcoin that 1 5% slide, 1 10% slide, which inevitably will happen, in a recession or in a pullback, and any type of cooling that takes place in the market. Bitcoin is a speculation. It's going to fall. It's probably going to fall first, like it did yesterday. It fell, I think it was 5%. That's going to happen from time to time. So if you own a company that's fully levered into something that can drop 5%, that impact to your book is going to be substantial, and your market cap and your stock price are going to fall drastically. And that's what's happened to MicroStrategy, where they've had huge sell-offs the past couple of days. And so for me, it's always looking for these pockets and moments in the market when things look like they can never fail. That's when I like the short, because as soon as you see someone on CNBC multiple times in a couple weeks, you hear their name, they're all around the press, they're hyping up something that is purely speculative, like Bitcoin and crypto. For me, it's like that is the perfect opportunity to short the position, because they're really peaking out on their marketing, on their hype, and again, it's nothing that can be proven with substantial value on the back end. So that's just, that's something I was looking at. It obviously played out. The market turned over recently, which fully supports and helps this, but that's also a cyclical wave of the market, which is cooling, pulling back, consolidation, those type of things always do occur. So that was one that I was
Yeah,
definitely
if
pleased
you
to see.
stack those things timing up, that it only
Always.
amplifies the move down. Yeah, it
Yeah.
kind of reminds me of that big upstart run back in 2021 when Mark Minervini was on CNBC talking about it, and he didn't remember what the company did. I don't think he knew, to be honest with you. He's mostly a technical trader, so it didn't surprise me. But when the host goes, "What do they even do?" and he doesn't know what the company does, that was like that was a bit of a top signal. And it just kind of plays into what you were saying. It's like when you have people on just kind of pumping their bags like that, and they don't even know what the company does or if there's any value there. That's usually when everybody's like, "Huh, what is the value here?" And then you get your slide.
Can't forget that he did that, where he was like that pause and he was just like,
We're breaking up.
yeah, we're breaking up. Let's rotate a little bit into politics for one brief moment, because it is an interesting thing that's developed, the gold card versus green card. I think it's a new policy that Trump is announcing by the end of the week, I believe, which is there's going to be a gold card for people who want a green card, and the gold card is, I think, in short, $5 million and an expedited route to become a citizen.
Yeah. So as we know, you can get a green card or a work visa here in the United States for a small period of time. And what Trump is attempting to do is he's trying to curb some of our debt issues by allowing people to come to the United States, but having to pay for it, kind of like a pay to play. And that brings up most people's first question, which is, okay, well, that really only allows people with money to get into the country. And I think the counterpoint to that is if companies want talent, they're going to pay for it. They're going to cover those costs so they can bring the best talent from around the world to come to the United States to work. So I think it's a good idea. Again, whether or not it's the best idea, I don't know, but what it is an idea, and it's one that does bring it does generate revenue for the United States. We know a lot of people want to come here to work right now. Why not just throw a price tag on it? It'll increase spend on some of our bigger companies here in the States, and it'll get us some better talent from around the world. Now, that does mean that maybe we get some people here that come here to quote unquote work that maybe are just wealthy and want to come to the United States for a period of time. So there's going to be some people that maybe slip through the cracks that aren't here for the right reasons. But what it will do, I think, is start to bring down some of the spend on the United States side and actually increase our revenue. I mean, $5 million a pop is a lot of money, a lot of money. I mean, you're talking 200 people for $1 billion. That's pretty significant, and I think it's a good idea. It's worth a shot, right? I mean, we're at a point right now, and we've talked about this, where the United States needs to start to cut back on some of the spend, and they need to do that by either slashing or they need to do it by raising more revenue. And maybe this goes into the conversation we had last episode, which is the savings are not going to be as great as they anticipate with Doge, and now they're trying to find more ways to make money to kind of offset some of our debt. So I think it's a good idea. I mean, if you have any opinions on that, what do you think?
I mean, it's a great way to accumulate wealth, right? 5 million per book. That's, you have to imagine at least there's 5 to 10,000 people that will do that, at least, like internationally speaking, with boatloads of money. So I think it's a nice way to accumulate, big money that can potentially push down the debt. I don't know. It's just all about optics. It's all about the way it's done and making sure that the problem really is that it kind of gives this overall advantage to people who already have a lot of money, which, there's surplus and stimulus that can come from that. Like you mentioned, them coming into the States, it can be an attractive thing because they could spend more money, they could open a business, they could do a lot more here. But there's also, there's certainly a transparency issue with, poor versus rich. And this is kind of a catering to someone with already the means to provide for themselves, when most people who want to come to the States from like an immigration standpoint don't have a lot of money, and they're trying to start a new life. So um, it's definitely a difficult topic. Like you could probably make a very solid argument on both sides of the aisle.
Yeah, one thing I did want to mention as well is this program, while it is new, so to speak, it's not a new concept. I think, I don't know how many extremely wealthy American businessmen listen to our podcast, but you obviously hear about being able to buy citizenship in various countries, especially in the Caribbean, Switzerland, to kind of gain access to accounts or passports from these countries. So it's not a new idea necessarily, and it does replace the EB-5 visa program, which is, foreign investors can come to the United States if they invest at least $1 million into U.S. businesses. So this really just ups the ante on that. It just increases the cost of investment and makes it more direct to the federal government as opposed to U.S. businesses, which is what it used to be. It was more of a broad stroke, and now it's becoming more focused, and the money is going directly to the government instead of broadly investing in U.S. business. So while a lot of people are shocked at this idea, it's not a new thing. This was actually introduced in the 90s. So that's just worth noting for anybody who's like, this is an egregious idea. It's like, no. This has been happening around the world for a number of decades.
Yeah, that's definitely good to know. Moving a little bit and like keeping on the theme of international, let's talk through China a little bit.
Yeah, so a few weeks ago we had discussed, I feel like every podcast we just talk about what we had previously talked about. But a few weeks ago we had talked about a rotation into international stocks as value for those stocks got really cheap, and American equities got pretty expensive. And we saw that rotation play out. We've now seen growth fall off on the American side, and we've seen international equities start to make a pretty historic run. I mean, China stocks are absolutely frying right now, and I think that just comes down to value. There was so much value sitting on the sidelines there as people were piling into American growth, especially like App, PLTR were taking the spotlight, while companies like Baba were trading at just extreme value, extreme value. And people are always like, what do you think about Baba as a buy? And it's like, it's a great company. If it were American, it would be 4 or 5 times the price. I mean, it would be in line probably with Amazon. But because it's Chinese and has exposure to the CCP, that poses a risk that most investors just push it aside. That being said, there is a point in time where the risk just the reward just heavily outweighs the risk of China, and that's what we're seeing right now. And this isn't anything new. We've seen runs like this in the past for Chinese equities, and that's kind of what we're seeing play out right now with those internationals. I would have liked to have seen Brazil play out a little bit better than it did, but Brazil, that I didn't know, I was informed by a friend of mine, told me that Brazil is actually so much more corrupt than I think the media leads on. Kind of like an Argentina situation where there's just so much corruption, it makes it almost uninvestable. So we didn't see a run in internationals in that part of the world, but the Chinese market has done extremely well over the last month or so.
Yeah, they've seen a lot of rotation and a lot of flows of funds into that general direction as the cooling has happened, and that's really all goes back to the risk reward. Like, where's the valuation? What is my upside? What's my downside? More importantly, if my downside's only 5-10% more, like max, then I should probably take a position here, because once the rotation happens, I could get like a really nice boost up. And we've seen that along the Chinese equities. Another thing, though, in terms of rotation, healthcare has been on a tear lately. Abbott breaking a 3-year consolidation and out to new highs. AbbVie as well, moving very nicely. Like, those two in tandem are just leading the market for healthcare. It's kind of funny to think that they're both one company not too long ago, which I have a lot of high hopes for Honeywell, which is going to be doing a spinoff to different individual companies, just like Abbott did with AbbVie, as we saw with GE. Obviously, the success of the GE stock and the business as a whole was largely due to the spinoff that they did. Honeywell is certainly one that I'm going to continue to keep my eye on because it generally bodes again like very successful for the business and for the stock when you have these spinoffs to individual business components. And so, in terms of healthcare, that just has to be something we continue to lean on and look at. It's been holding up the market as much as it can, as long as, really along with industrials the past 2-3 days, while the S&P has split just because growth in tech has been sold off so heavily. The question that I have now with healthcare is what's next, right? We saw some rumors and some hype about the Wuhan virus being back, a different one now that's potentially worse than COVID. I know that's like a lot of hype and speculation, and there's not like a lot of validity to the research or the viability if that's going to happen yet. But I still think healthcare has been sold off the past 3 years and like really undervalued for its value, just from a traditional fundamental standpoint. So like I'm interested to see how much will this be invested in as a safe haven in the next 3 to 6 months. If Nvidia crushes earnings today, will they just drop the next couple of days and go back to where they were for the past 3 years and growth in tech take right back over? Or are investors changing their tune? That's one thing I'm definitely watching.
Yeah, so healthcare is notoriously difficult to invest in, especially when it comes to like biotech and some of the more speculative healthcare stuff. But you are, I mean, as far as I'm concerned, you're a notorious healthcare investor. You have previous experience working at Abbott. What, when you, besides just outright fundamental value, what are you looking for in these companies? Are you following new drugs that are coming to market? Are you, are you somebody who's investing in the trends like the Ozempics, the GLPs? What's kind of the thought process there? Or are you just watching names that you know well at this point and that's really it?
Yeah, I wish I could say I watched the drug phases and trials and all of that, but I don't because there's so much risk in that process. And I know a couple of people who work in the research behind those phases and the reportings behind them. And it's just, it's one, there's a couple things. One, there's a lot of inside information that gets traded around within that environment that makes it kind of difficult to understand. And just like it's a large risk to like know people in that industry because like it's highly sensitive to corruption and like getting paid to make sure that trials and phases and in terms like medical research looks the way you want it to look. It's fraught with fraud. Um, so that's one thing I just don't put that much weight into because at the same time, like you can pass a phase one, a phase two, and then out of nowhere, get crushed on a phase three, even if you're set up for success. Like a lot of things can go wrong. So what I do is I just look at historical success. And I honestly, a lot of healthcare is highly political because there's such an intertwine with the government and with government funding, especially through WIC or any of those other health related subsidies. So I watch primarily Abbott and AbbVie. I mean, I'm always going to look at J&J as like a very strong leader in the market, but I try to stay away as much as I can from speculation in medical because it rarely, if ever, works out. There's always going to be those, small handful of therapeutic companies that do really, really well. And I'll try and catch on with the trend. But when I try and catch on with those, like the speculative, high volatile, but high growth healthcare names, it's really more so from a technical perspective. So like one of the largest trades I ever had was Tandem Diabetes Care. And at that point, I bought Tandem around $3 back in 2017, I believe. It feels like a really long time ago now. I think it was late or it's like the summer or is the fall of 2017 and rode that up until about the 60 range. And that was one of like the first big equity trades I ever had that really unlocked my portfolio. And at the time, I entered it because I worked for Abbott and I was learning more about the diabetes infrastructure and the market and a little bit more about Tandem. And they had a leadership reversal at that time where they kind of clean house and they're like, let's try and do this again. And at that point, I also had experience with Roche. I was one summer in college, I spent my time working in hospitals doing technical work for Roche diabetes monitors, the AccuCheck. And so I was starting to get more familiar with the AccuCheck and the Roche side of things. And then I branched into Abbott and understood a little bit more of that market space. And there's just kind of this gap within it that Tandem could fill, and their product was good. They just had really bad leadership at that time. So for such a low valuation of $3, I took position, and that's how it played out. So like using that example case, healthcare is very tricky to trade, as you mentioned, and like it's a tough thing to invest in because you either have to be on the inside and like really understand what's happening with your infrastructure versus your competitors and like how sales are progressing and where you think the opportunity will be. And if you're not on the inside and you're not working in that environment and you're on the outside, it has to be, for me at least, it's always been technically driven based off historical success. So like I'm looking at those big three, like a J&J, an Abbott, and an AbbVie, and I'm waiting for the technicals to look really good. And then I'm taking position, understanding that there's just this intrinsic fundamental value with the company that should propel price, especially if it's breaking technical markers that it hasn't before. So like AbbVie recently, I took that trade post earnings. And for me, it was really easy to do because the technicals looked so good. And at that time with tech and growth rolling over and healthcare already getting a lot of the flow of funds, like it was just a really beautiful setup. So that's one thing I'd say about healthcare is, generally speaking, in most trades in my history, you can trust the technicals when they look really good because the volume and the support is naturally going to be there. And, you know, you think about like, why is that? Well, AbbVie gives an incredibly high dividend. Like from a terms of like passive funds, it's a great investment to always be a part of because their stock performs well, but they pay out through the wazoo. And Abbott has one of the largest, you know, I've talked about this before, but they have one of the largest like historical successes of being able to produce a dividend on a consistent basis. And not just that, but like increasing their dividend every quarter. I think they've done it consecutively for something like 60 or 100 years. It's like when the market opened, like they've just done crazy work with it. So when you have that type of, again, like passive fund flow from an equity like Abbott or AbbVie that has historical success, really nice revenue, sales, a big part of the infrastructure of the medical world we live in today, or a J&J, and then you have a good technical setup, you're de-risking a lot just through those things, right? This is not a SoundHound. This is not a quantum computing, you know, startup that was then, you know, used to be an energy drink company.
There's no need to attack me. There's no need to attack me here.
There's attacks are coming. You know, these are companies that provide like really legitimate federally authorized products and at the end of the day, like life-saving materials to people. That's just like kind of my 2 cents on medical. It's just, you know, TLDR in short, if the technicals look good and it's a really
business,
well-respected medical business like an Abbott, J&J, AbbVie, it's really good.
Yeah, meaning they're not in phase trial for their only drug.
Right.
I think that's where a lot of people get caught up in healthcare, and especially the biotechs, where they're like, this company is going to change the world. And it's like, okay, but they have no drugs and all they do is lose money and they're operating on grants. And if they miss phase 3, they're going down 90%. That I think that's where a lot of people get confused in healthcare, and they think that's where the value is, when in reality, it's in the companies that have, you know, a slew of 10 to 15 drugs that all have 10 to 15 years on their patents left. And, you know, I think that's where the real value is, not necessarily in the more speculative stuff. But yeah, I think that about wraps it for today. Again, Nvidia earnings, we're probably going to have another call on Friday, just kind of discussing the aftermath of Nvidia earnings. But as far as today goes, I think that about wraps it. We've got an article coming out tomorrow on the infrastructure trade in the event that markets do slide. The anticipation of stimulating the economy through infrastructure spend. I think that's something Trump is going to look into. So yeah, article coming out tomorrow, another pod coming out on Friday. If you enjoyed, drop a follow on the pod or either of our Twitters, which should be in the bio here, at Tanner's Trades, at the Clam Shanks, to see our day-to-day interaction with the markets. And yeah, do you have anything else to add?
No, that's it. Let's see what happens today.
Now watch this drive.